All right, welcome. Today we are pulling back the curtain on one of the buzziest financial products to launch in, well, years. The iShares Bitcoin Trust, ticker symbol IBIT. We're going to break down what it is, how it actually works, and maybe most importantly, the fine print you absolutely need to be aware of. Let's get right into it.
So let's just start with the main question here. You're interested in Bitcoin, right? But maybe the whole idea of digital wallets, private keys, and figuring out a crypto exchange, it just feels like a lot of hassle. This is the exact pain point a product like IBIT aims to solve.
And to really get why products like this is such a big deal, we first have to understand the hurdles of just buying Bitcoin the old-fashioned way, on your own.
You know, when you buy Bitcoin directly, you basically become your own bank. You're the one responsible for keeping it safe, and that can get complicated fast. And then you've got the whole tax situation. Trying to report everything correctly can be a massive headache for the average person.
So, that's the problem on the table. How does this new fund from BlackRock claim to be the solution? What even is it?
At its core, it's actually a really simple idea. IBIT is an exchange-traded fund, an ETF, and its one and only job is to track the price of Bitcoin. You can buy it and sell it through your normal, everyday brokerage account, just like you would a share of Apple or Amazon.
And here's a look at how it plugs right into the traditional financial system. It trades on the NASDAQ, a major stock exchange, sitting right there alongside everything else you're used to seeing. The whole point is to make investing in Bitcoin feel familiar, almost normal.
Now, if you go to the iShares website, they lay out three main selling points for the fund. They even have a brand for it. Why IBIT? Let's quickly break these down. Simple access is just about how easy it is. You use your existing brokerage account, done. That simplicity helps drive high liquidity, which is a fancy way of saying a ton of shares get traded every day, making it easy to buy or sell. And underpinning it all is the integrated technology. That's the partnership between BlackRock's management and Coinbase's custody, where they hold the actual Bitcoin. Okay, so that's the pitch. But what does this all look like in practice? Let's peek under the hood and look at a few key numbers to really get a sense of the scale we're talking about here.
First up, the price tag for all this convenience. The sponsor fee is 0.25% a year. That's the cut BlackRock takes for managing the whole operation. Now let's see just how big that operation is.
And whoa, the scale is just staggering. The fund is holding over $87 billion in assets. That just goes to show the incredible tidal wave of money that flooded into this thing almost as soon as it launched.
And all that cash generates a ton of activity. On an average day, we're talking about more than 43 million shares changing hands. This right here is that high liquidity advantage we just talked about, but in real concrete numbers. It's a very active marketplace.
So after all those absolutely massive numbers, we come to the most important one of all. One. This multi-billion-dollar fund holds exactly one thing, just Bitcoin. Its purpose is completely laser-focused on that single goal of tracking Bitcoin's price. And now we get to what is, without a doubt, the most important part of this entire conversation, the risks. Because while they've made the access simple, the asset underneath it all is anything but, and the fund's own legal documents are extremely clear about this. This is a direct quote. I'm going to say that key part again. Persons who can bear the risk of total loss. The company that created this fund is telling you, point blank, that this is a high-risk speculative investment where you could lose everything. And here is another absolutely critical distinction. Most of the ETFs you probably own are registered under something called the Investment Company Act of 1940. IBIT is not. And that means it doesn't have the same regulatory framework or investor protections as a standard ETF that holds stocks or bonds. And the list just keeps going. The prospectus calls out the extreme price swings, the fact that its value is totally dependent on people continuing to believe in Bitcoin, and, of course, security risks like hacking. It also makes it very clear that there's no FDIC insurance here like you get with a bank account. This is a really interesting mechanical detail you have to understand. So how does BlackRock get paid that fee? Well, the trust actually sells off a tiny fraction of its Bitcoin holdings to cover the costs. That means, over time, each share you own actually represents a slowly, slightly shrinking amount of Bitcoin. For your investment to go up, the price of Bitcoin has to rise faster than the slow decay from the fees. So we'll leave you with this final thought to chew on. Products like IBIT have, without a doubt, made it incredibly simple to invest in a notoriously volatile and complex asset. But here's the real question.
Does making something easier to buy actually change how risky it is? That's the question every single investor has to answer for themselves.